It's 10 a.m. in Hong Kong and China. I'm Emily Tan. Let's get to your headlines. Asian markets are staging a comeback today with gold, silver, oil, and crypto also seeing a bounce after a wild few days. The U.S. and India finally reaching a deal. Amitoj Singh is on the ground in New Delhi.
The focus will be on the rupee. It's already strengthening against the US dollar and the markets. GIFT Nifty futures indicating that the market will jump 800 points at least, about more than 2%. So there's a lot to cover right here in India.
And President Trump launching a $12 billion minerals stockpile to secure critical resources for U.S. businesses.
And coming to you live from the Singapore Air Show, just days after U.S. President Donald Trump threatened Canada with new tariffs unless it quickly certified certain models of Gulfstream jets. To get the company's reaction to that, we'll be speaking with a senior executive in the next hour.
A very good morning and welcome to the China Connection. Taking a quick check on markets across Asia this morning. We were green across the board on Wall Street. The S&P up now for 3 straight sessions, and it's playing out like this. Jakarta still continues to be weak. Of course, we've been tracking the developments there with the MSCI, some of the warnings coming through. We had the stepping down of the CEO of the IDX, so that's what's happening in that market. But a huge comeback that is coming through across the Japanese markets and the Korean markets, which is the standout today. The Kospi better for 4.5% at 5,171. We are going to be waiting for the gap up in the Nifty 50. The Indian markets in response to the latest U.S. India trade deal. So we'll watch as the Indian markets get up and running in a short time from now. But the TAIEX also better on the session by 1.5%. And we're looking at the Hong Kong market at 27,014. So strength in Asian markets this morning. Greater China markets getting caught up in the broad sell-off yesterday, and that's after we saw the Shanghai Composite sinking 2.5% in its worst single-day performance in 10 months. The Hang Seng Index sinking about 2.2%. So recovery that we are seeing in the markets today. The Hang Seng better for almost 1%. We're checking in on the commodity space, which is where we saw a lot of sell-off playing out yesterday. Gold and silver recovering after sharp losses. Some of that sell-off was due to higher margin CME margin requirements for precious metal futures, which took effect after the market closed on Monday. Currently, we have gold at 4,830, well off the 5,500 that we were sitting at last Thursday. Silver at 84.20, also off record highs. Oil prices dropped nearly 5% on the prospect of a de-escalation between U.S. and Iran. Currently, we're looking at WTI at 62.24. Brent last traded at 66.34. Cryptocurrencies also seeing some gains today, though Bitcoin is still below the 80,000 level. 78,800. Ether traded at 2,346. Now, one of our top stories today, India. The markets will be watching as the GIFT Nifty futures pricing in a 3% pop when those markets get up and running in about 2 hours after the U.S. announced its slashed tariffs on Indian imports to 18% from 50%. Inside India anchor Amitoj Singh is live in New Delhi and joins us now with the latest coming through from this trade deal. Amitoj.
Emily, thanks so much for that. We're coming to you live from New Delhi, and what a week has it been. We've been looking at, of course, India Energy Week, then there was the EU FTA, and then, of course, India's budget. And a day after that, what's happened? Trump and Narendra Modi, India's Prime Minister, had a phone call that was much awaited, and that's the big takeaway. It was always speculated that it's on Trump's desk, and it's just about him signing it. The other speculation was that we're awaiting Prime Minister Modi's call to President Trump to request him to lower these tariffs. And according to the Truth Social post by President Trump, that's exactly what happened, that it was on the request of Prime Minister Modi that this happened. I just want to take our viewers through some of the big highlights, the questions, the takeaways that we can get into. So the deal was always dependent on India buying energy from the US is what we understand. And part of that has been signaled. 500 billion is what is expected. Can India actually live up to that? India not suggesting that in Prime Minister Modi's post on social media, on X, but we'll have to wait and see the fine print. This is not a full FTA. This is, as we understand, according to analysts, early harvest agreement, which is basically a limited trade pact which delivers quick tariff cuts, and then they can negotiate the finer print. Nifty 50 expected to jump more than 800 points. Already we are seeing that based on futures, GIFT Nifty. India will buy Venezuelan oil, according to Trump. Now, this is interesting because India hasn't said the same thing in its own social media post. Prime Minister Modi not saying this. During Trump 1.0, it's interesting to note that U.S. was the #1 energy provider for India. So that's a key factor. The markets, of course, will be flying high, but when the devil in the details emerges, we're going to have to wait and see whether the fact that they had initially priced in the idea, oh, wait, even if we get 25% tariffs from the U.S., that's great. Just reduce it from 50 to 25. Now they've got 18, which is better than all emerging markets. That's a huge deal. The problem is India has already suffered all the way from August to now. So we're going to have to wait and see how that pans out and whether the fine print is going to be convincing for the market. The other thing, trade analysts I just spoke to, saying a couple of different things, that the Indian markets will be happy with 25%, were happy with 25%. This will be very good. And this is now effectively making India in the category of preferential treatment from the U.S. Trade deals are routinely negotiated and renegotiated. That introduces a fresh level of uncertainty. So don't get too happy about this particular deal. The other aspect is that even an early harvest agreement or a full FTA, they're both volatile in this new geopolitical order. So hold your horses. The other thing, the questions that have emerged from what we know so far. Does this turn around investor sentiment in terms of foreign investors? Do they pump money back into India when they've always been saying India is great for the long game, but not for the short game? Then, has India actually agreed to buy Venezuelan oil? Has India said it won't buy Russian oil? Or has India said that it would reduce buying Russian oil to 5%, to 10%, to 15%? We don't know right now. We're waiting to hear from Indian officials who will still be waking up to this news, of course. What has India agreed to when Trump says zero tariffs? What particularly has India agreed to? What is the red line for India? Is it still dairy? As we understand, dairy is still the red line. It was always the red line. Agriculture, which aspects of agriculture have been the red line as this has been announced? Additionally, could India suffer going forward a South Korea-like threat? So is this a done deal, this 18%, or could things change, later? And I think one other final question is, will India buy civil nuclear equipment and natural gas from the U.S.? Because India has been, introducing a slew of reforms, including in nuclear. So we'll have to wait and see what are the side deals made in this big deal. And that's what we're waiting to hear from officials. Of course, negotiations will continue.
Amitoj, very important to get the Indian side of things and the confirmation there, and that's why we have you there. Thank you very much for your report. The latest tariff coming through puts India in line with its ASEAN peers of between 15 and 20%. We know the likes of Korea, Japan, Taiwan at 15%, and then Indonesia, Malaysia, the Philippines at 19%. Also comes after India just within a week striking a trade deal between the European Union and India as well. So we'll keep top of the story, and we'll be watching for the market open in India in about an hour and a half from now. The U.S. looking to counter China's stronghold in the critical minerals space. Earlier this morning, President Trump announced the launch of a strategic stockpile called Project Vault. With roughly $12 billion in funding, the project will acquire and stockpile minerals for American auto and tech companies. The administration also plans to maintain a 60-day supply for minerals for emergency use. The initiative has attracted interest from a wide range of American companies, including automaker General Motors, whose CEO Mary Barra was at the White House event on Monday evening. Here's some of what Trump said at the event.
Just as we have long had a strategic petroleum reserve and a stockpile of critical minerals for national defense, we're now creating this reserve for American industry, so we don't have any problems. This historic initiative will combine $10 billion in export-import bank financing with $2 billion in private sector financing, and we even expect the American taxpayer to make a profit from the interest on the loan used to start the Project Vault. It's an amazing thing. They've been talking about it for years.
You're looking at live pictures of Taiwan's President Lai Ching-te. This as Taiwan announcing just minutes ago that it's planning to build a production line for rare earths. This is to meet 50% of domestic demand. Taiwan's economic minister says the U.S. is also keen to invest in that rare earth supply chain. Taiwan imports around 3,000 tons of rare earths every year, but most of that comes from Europe, Japan, and the United States. So live pictures of the President Lai Ching-te there coming through from Taipei. And turning to markets, we want to look at the newcomer in the Hong Kong market today, and this is Eastrock Beverage. This is China's largest drinks maker by volume, also into energy drinks as well. The shares were priced at the top of the range at $248, and just a slight negative bias that has played out. The shares did open modestly higher about 40 minutes ago, 247 and change last traded. The company raised $1.3 billion, making it Hong Kong's largest IPO listing so far this year. It is dually listed, so Eastrock also listed on the Shanghai market. If we do have that board, we can show and compare. We don't expect anything like contemporary Amprex, which has a huge premium in the H shares that traded in the Hong Kong market, but Eastrock is also Shanghai listed. What I also want to note here is the huge flurry of IPO activity in the market here. Now count them 440 companies waiting to come to list in this market. This, as we got the latest data from the Hong Kong Exchange yesterday, 26 have been approved, 414 under process, and this follows in the footsteps of 12 listings in January, raising $4.2 billion. Now this has got the SFC, the Securities and Futures Commission, flagging serious deficiencies in Hong Kong's IPO listing applications, and with that calling for stepped up scrutiny, telling banks to review their procedures. In fact, they've asked 13 listing sponsors to conduct a comprehensive review, meantime suspending 16 listing applications deemed not up to standard. The SFC CEO saying that the gatekeeping role of sponsors in the listing process is critical to maintaining quality of Hong Kong's capital market, and that role may have been eroded in the eagerness to pursue the deal volume. So just this warning coming through from the SFC and the Hong Kong Exchange. The bourse operator shares down 0.6%, and this is underperforming the broader market. The Hang Seng Index higher by 0.5%. Vis Nayar is a CIO of Eastspring Investments and joins me around the set here. A very good morning to you, and thanks for coming to see us.
Thank you, Emily. Good morning.
There's a lot going on in the markets today, lots of different dynamics that we can talk about. And I first want to ask you, of course, we had Amitoj in India talking about the latest trade deal to come through, and not confirmed by India yet, and we don't have the details on when the start date or whether or not they're going to be really ending this Russian oil purchase. But in terms of the steady flow of trade deal announcements coming through from President Trump, and then these other deals that countries individually making bilaterally outside, how does this impact market trade? How does that impact sentiment?
I think the clear thing, we've had some overhangs on market sentiment in Asia. If we go back to the last 15 months or so, certainly worries at the start of last year around trade deals in general, the uncertainty in the second quarter, and the subsequent striking of deals. I think your reporter was very, very succinct when he talked about the uncertainty still going forward around, are these numbers real? What are the conditions attached to the deal? The fact that some deals have been renegotiated. So there is an awful lot of uncertainty still as we await further details of what India has actually agreed to. So I know you mentioned oil and other, where they buy it from, the trade with the US, and indeed whether they purchase oil like they did in the first Trump presidency. Lots of debates around it. But generally the mood music is that India was an outlier in terms of having a particularly frosty relationship with the States compared to some of the other Asian trading partners. I think that this news will move them forward, at least in terms of sentiment in the market. We see the early move in the futures in terms of that sentiment for investors. But looking in a wider lens, India has been a very different market. I think North Asia has been very much more geared into the AI trade and indeed the tech trade and the move in markets, whereas we've seen India being a little bit of a laggard on performance because it's much more domestic focused and perhaps a little bit of an overhang on that sentiment of the relationship with the US. So let's hope that this is an opportunity for investors to look a little bit more confident at India and looking at the potential for outperformance there as well.
Does this do anything, change anything in terms of international interest into any of these markets?
So I think our motto around Asia is increasingly think Asia, think active. So within each Asian market, the drivers are necessarily quite different. You saw that markets were moving this morning. We know the situation in Indonesia around MSCI, but also we think of North Asia. China's been very much, you look at the market movements in China, sectors like technology, innovation have done very well. More staples, defensive utilities, those sectors have not done so well. When we think of India, we know that China property has not been, there's some overhangs on China property, some concerns, but property in India is in a multi-year upmarket. It's a very different position. So really for us, when we think of each market, we think of the stocks and the sectors in each market that make a difference. And I think overall, trade deals mean that the mood music is a little bit more positive than perhaps it was a few months back.
Are you constructive or have any favorites in any particular markets?
So when we think of a market sector, we think North Asia is very much that sector. So look, Japan, we think very much around the technology sector. But also when we think of Japan and where valuations are, we think the governance reforms have led to improved profitability. But that profitability, we're much more interested in mid-cap, small-cap in that space. China, very much around technology and those sectors associated with the consumer, less so around utilities, etc. India, very much around the domestic play, continues to be there. I think we need to get more details on what the trade deal looks like, but one presumes that would be positive, at least in the first reading. And then we think of places like Singapore. You know, Eastspring, headquartered in Singapore, we look at an incredible performance in that market as very much policy-driven and very much around the government and the support of the market. So I think each country and each sector needs to be looked at in its own values.
Can we also talk about commodities and the metals, the way that they've traded in the last couple of sessions, record highs that were set last Thursday, only for them to experience a huge wipeout. We're talking about gold, we're talking about silver. What do you make of this soaring to record high and then this crash?
So I will just share an anecdote. I was seeing clients last week on Wednesday, and we were asked exactly that same question. Sentiment was very different on Wednesday when it hit 5,500. In the end, the attraction in commodities from a portfolio perspective is as a store of wealth. It's not a dividend store. The valuations are not, it's not based on something fundamental. It's very much around sentiment. And the sentiment was some worries around where the Fed was heading, what the appointment was going to be like. We've seen a correction when the Walsh announcement was made. It got out to markets. Perhaps interest rate, the journey of U.S. interest rates is not quite where we were. The worry of the long end of the curve isn't quite where we were. So very naturally, I think, in a portfolio perspective, there was a little bit of drop in the commodities. So that, of course, is seen as volatility. We're looking at the latest numbers, 4,800. Yes, it's recovered a little bit. But to me, gold, commodities, these have been diversifiers. And I think the big message I do want to take to investors, diversification has become increasingly difficult. Markets have been very concentrated, driven by a relatively small number of stocks and a theme from the US, which is spread globally. Diversification is harder in this world where inflation might be a little bit higher than it's been in the past. And we saw in periods last year when bonds and equities were positively correlated. So that's what it takes investors to find diversifying assets. Commodities, of course, is one of those.
I want to ask about silver in particular because we know that it has a split personality. Of course, it's a safe haven, but also it has industrial uses, which in terms of supply deficit, that's existed for the last 5 years. We need silver for everything when it comes to solar panels, to semiconductors, and those, of course, are a very hot topic, hot in demand right now, the latter, semiconductors. So what would you be doing? Would you be buying silver now? How would you be treating these safe havens?
So I think that safe haven assets, under the heading of safe haven assets, but as we're seeing a level of volatility that doesn't always sit with the word safe, right? So I think that silver is part of the minerals and commodity set of assets. I think that clearly the price moves that we've seen are less fundamental as they are around speculation and around some kind of portfolio-driven decisions to seek out assets that are diversifying. That is going to be driven a little bit more by sentiment, and sentiment has undoubtedly changed a little bit in the last few days. I think that as we look forward, it's very interesting the US's efforts on rare earths, minerals, and I think the whole range of assets around commodities and rare earth minerals continue to be a challenge for supply chain. So any efforts to protect the supply chain and protect supplies will hopefully stabilize pricing rather than allowing it to be more speculative.
I want to get your take on the Fed nomination, Kevin Warsh. Expectations that he intends to shrink the Fed's balance sheet. Also, maybe less commentary, less forward guidance. What does that mean for you?
So at the moment, all we have is those pronouncements he's made in the past. Number one, I think we still have that uncertainty. We need to see exactly what has been agreed around his nomination and how his role. But undoubtedly, he's signaled the view that he wants to cut the balance sheet. He's signaled that markets certainly believe that the short end of we're less likely to see very fast rate cutting. I think that what he has done is he's brought a degree of comfort. I think that some of the candidacies were a little bit worrisome to markets, and I think that we still have had U.S. inflation at higher level, well above 2% for many quarters. And he signaled that he wants to be a little bit, at least we take it at the moment, that he's going to be a little bit more structured. Long end rates are maybe a little bit less of a worry than they were. That's all we have so far. I certainly want to see a little bit more in terms of real statements before we have a view of this is what it will look like.
As we look to central banks this week, RBA will be making its decision today, and it's going to be doing something different. It's going to be hiking, where all the other central banks are still in their easing mode. What will that do?
Well, I think we have, not forgetting the Bank of Japan as well. So,
yes.
So we have these outliers which are on a different cycle, and they're raising rates. I think in terms of each central bank, I think if I can just report on Asia as a whole, we look at Asia, it's a big regional that we can invest in. Obviously, each country might have slightly different stages of policy. But as a whole, higher growth, lower inflation, potential to have fiscal support. I think that the overall opportunity set in Asia is predominantly strong. And within each market, Japan is another example, you need to be more thoughtful about where your capital is allocated. So again, I go back to what I said earlier. When we're investing in countries, we're really thinking of the security opportunities and less so about a country opportunity.
Let's bring it back to here in Hong Kong and China. And one of the stocks that I'm watching today is the newcomer. This is eStock. This is a consumption stock. How are you playing the China and Hong Kong market as we head into the two sessions, which will start in March?
Well, Hong Kong's had a great year, certainly in the last year. So I think, number one, Hong Kong, each market has its different. I keep going back to the same theme. So, for example, Hong Kong property is something where we see it as recovering, very different to the China story with oversupply and overproduction. Within the context of the markets, we like the consumer sectors. We think and it's technology, innovation, these things are super important in these markets. And the utility and more staple type sectors, perhaps a little bit less interesting. And I think that when we allocate both in credit and in equities, we're worried about that, and we feel really quite thoughtful around where valuations are. If we think of fixed income markets, certainly EMD, we think of sovereigns rather more than corporates because spreads have been quite tight. But those markets have also delivered particularly strong returns in the last 12 months. So there's a very, very great opportunity both in fixed income and in equities within Asia. But you need to do a lot of fundamental work to make sure your capital is in the right place.
Vis, thank you very much for coming in and having this conversation with us today.
Thank you, Emily.
We've been speaking with Vis Nayar from East Spring Investments. As we head into a break, we'll leave you with a look at how sectors across the mainland markets are performing this morning. The CSI defense and semiconductor indices both up 2%. Infrastructure is a laggard, down about 2%. The China Connection will be right back. Welcome back to the China Connection. Iran confirming efforts at diffusing tensions with the U.S. The country's foreign minister told reporters that Tehran is reviewing the details of negotiations with the U.S. Nuclear talks are expected to begin this Friday on February the 6th. Representatives from Saudi Arabia and Egypt are also expected to take part. President Trump also confirming talks underway even as the U.S. builds up its military presence in the Gulf.
Well, we're talking about that. We have ships heading to Iran right now, big ones, biggest and the best. And we have talks going on with Iran. We'll see how it all works out.
Chinese independent refiners, also known as the teapot refineries, are reportedly snapping up Iranian heavy crude at discounted prices. The Iranian crude is meant to replace Venezuelan shipments to reduce reliance on a country that the U.S. now claims control to. Iranian heavy is reportedly sold at $12 a barrel, cheaper than the standard Brent crude, equivalent to Russian euros. As we head into a break, we'll leave you with a look at the biggest movers on the Hang Seng Index this morning. The benchmark edging higher after losing 2.2% in yesterday's session. The China Connection will be right back. Tracking a rebound in Asian trade this morning, and the standout is the Korean Kospi, up 4.6% at 5,179. The Nikkei 225 gains of pushing 3%, and the S&P ASX 200 traded higher by 1% ahead of an RBA decision that we are expecting in about 1 hour from now. A hike of 25 basis points is expected. That's after December inflation coming in hotter than expected. So we'll break that number as and when it crosses. In Jakarta, we're looking at continued weakness in that market following the warning from the MSCI about its we've seen, of course, now the free float has to be increased to 15%. That was a suggestion by the stock exchange. And then we had the resignation of the CEO of the IDX. So a weakness for the Indonesian markets. Down in New Zealand, also down on the day by 0.2%. Moving over to the Greater China markets, flip the boards, and in Hong Kong, we have now flipped into negative territory, pulling back by 0.3%, extending on from yesterday's 2.2% loss. The TAIEX up 1%, 31,963, and the Shanghai and Shenzhen markets are fractionally higher, 2639 in Shenzhen. A couple of stories that we're watching this morning. Alibaba says it will spend 3 billion yuan or $430 million this Lunar New Year to bring more users to its Qwen AI app. That's 3 times the 1 billion yuan that rival Tencent announced it would spend on its own AI chatbot. This as the race in Chinese AI and apps continues to heat up. The Lunar New Year period is generally when tech companies launch new promotions or features to draw in more users. In 2026, Lunar New Year ushers in the Year of the Horse. And this year, a toy that's gone viral across China is the horse plushie with its smiley face sewn upside down. It's an indicator of a broader gloom across the Chinese economy, which could weigh on Beijing's efforts to drive consumer sentiment. CNBC's Eunice Yoon takes a closer look at some of what's clouding China's mood.
To get a sense of Chinese consumer confidence, visit Beijing toy seller Gaolan. For the Year of the Horse, this frowning horse is selling out. A factory worker had mistakenly sewn the plushie smile upside down, creating a runaway hit here known as the crying horse. Nowadays, there's so much stress in our society, she says. The crying horse reflects how people feel inside.
The popularity of this horse is just one indication of a gloom in Chinese society that appears to be building as the economy slows down and people feel less certain about the future.
Another metric of the melancholy is the viral sensation, Are You Dead? In early January, the app topped the charts of Apple's App Store here. It's meant to give people living alone peace of mind that if they die, someone will notice. For $1 a month.
The way it works is that you check in with the app every day. If 48 hours goes by and you haven't pressed this button, the app will send an email to your emergency contact.
1 out of 6 households in China are single person, a reason these dine-in cubbies at McDonald's have become popular.
Because of China's aging society, more elderly are on their own. And many young people who move to the cities for work don't have siblings and aren't partnering up.
China's marriage rate hit a historic low in 2024 of 4.3%. Despite the demand, the Are You Dead app is facing a death of its own. The government appears sensitive about the morbid outlook. Apple told CNBC China's cybersecurity watchdog ordered the app's removal from the App Store because it fails to comply with rules to adhere to public order and good morals. In a statement, Apple added, "We follow the laws in the countries where we operate. The app remains available for download on all other storefronts where it appears." Yet the anxiety remains. There's a lot of bitterness and a feeling of unfairness, this customer says. If you can't cry out loud, this horse can cry for you. Eunice Yoon, CNBC Business News, Beijing.
In other stories, a rocket and a satellite company, SpaceX, has acquired AI startup XAI, putting together 2 of Elon Musk's companies under one roof. The value of the merged company is $1.2 trillion. XAI trains large language models and owns the chatbot Grok, which can be used on X platform. It has been spending heavily to keep the Grok model competitive in an increasingly crowded market. Leaders in commercial aviation, defense, and space gathering in Singapore today for the 10th edition of the Singapore Air Show, which kicks off today. Our travel and transport reporter, Monica Petrelli, is on the ground leading our coverage there. Monica, what are some of the themes that you're seeing this year?
Good morning, Emily. Well, supply chain problems and geopolitics dominating the biggest themes of the day, which is why we've spent a lot of the morning talking with defense companies. But air shows like this also a chance for business jet makers to bring the latest and greatest among the fleet to showcase to potential buyers. Now, behind me, we have a Gulfstream 700 along with the Gulfstream G800. Both have recently, in the last 2 years, been certified by the FAA. These are also both models that were recently name-checked by U.S. President Donald Trump in a Truth Social post where he said, unless Canada quickly certified these jets, he would decertify all Canadian-made aircraft and also potentially add new tariffs onto Canadian-made planes. Now, we heard from ICAO's new president, Toshiyuki Onuma, yesterday. He said neutrality is key to the certification process because underlying it is public safety. IATA's Director General, Willie Walsh, also saying it is not right to put political pressure on the certification process. But here to talk to us today about this incident is Gulfstream itself. We're here with Scott Neal. He's the Senior Vice President of Worldwide Sales at Gulfstream. Scott, so good to see you again. Welcome to the program.
Good morning, Monica. Good to see you again. It's good to be back in Singapore.
So I imagine Gulfstream might have been surprised to find itself inside a post from U.S. President Donald Trump recently. You know, what was the reaction from the company?
Well, we're aware of the post that the president made. I think that he addressed a situation that's been going on for some time now. Gulfstream has 4 aircraft that have been certified by the FAA and EASA in Europe, and 3 of them have also been certified by the UK Civil Aviation Authority, yet still not certified by Transport Canada. One of the aircraft, our G500, was certified back in 2018 by the FAA, shortly thereafter by EASA, and it's still not certified in Canada. So we do have an issue that's been going on for quite some time. We believe that that doesn't match up with the bilateral aviation safety agreement that exists between the United States and Canada. And on behalf of Gulfstream, we're just going to continue to do what we do. We're going to continue to try to get our airplanes certified around the world. They have been certified by the FAA and EASA and other aviation authorities, including the CAA.
And is certification in Canada, does it typically run late? Is this an unusual thing that's happening? And has Transport Canada given any rationale as to why the certifications of these models has not occurred?
I won't comment on what Transport Canada may have said or not said, but it is an unusually long amount of time to get an airplane certified or validated by another aviation authority. So we're going to continue to do what we can to get the airplane certified so we can sell our airplanes and deliver our airplanes into Canada. But other than that, we're very happy to be back here at the Singapore Air Show with our G700 and G500.
And obviously certification key to getting the planes up into the sky, but if without certain certifications, does it impact sales?
Well, it hasn't in the past when we've been able to get airplanes certified by foreign authorities. So we're hoping that we're going to have success with Canada very soon.
Okay, so let's talk about the broader business. Sure. Last year, Gulfstream saying it had its best year ever for deliveries. Now, we know supply chain's still huge. In fact, IATA calling it the biggest headache in aviation. So how were you able to achieve that?
So we did have a strong year last year for deliveries. We delivered about 158 aircraft. It was a great year for us. Supply chain pressures have tempered quite a bit since post-COVID. But that's because Gulfstream has taken a lot of effort and made a lot of initiatives to manage our supply chain, including appointing a new head of supply chain for Gulfstream, including embedding Gulfstream employees with our suppliers. So we've got a pretty good handle on the supply chain now. It's not where it used to be, but we're doing okay with supply chain issues right now.
And demand, we continue to see that K-shaped economy, no end in sight here. So the wealthy really continuing to thrive. How is demand going in the future?
We've seen very strong demand for the Gulfstream product line around the world, really driven by the investments we've been able to make in the product line over the past 20 years to bring an all-new fleet of aircraft to market, including the 500 and the G700 here. We're seeing demand across all segments, so large corporations, public corporations, private corporations, the Fortune 500, high net worth individuals, and also governments around the world that use Gulfstreams for government missions.
And so we know a major theme today is geopolitics. So geopolitics tripping up commercial aviation. It's another difficult pain point for that side of aerospace. For defense, though, it's quite a boon. How about business jet makers? How do these geopolitical tensions affect a company like Gulfstream?
Well, there's always issues that we deal with around the globe, whether it's economic or political considerations, elections, economy, stock markets. So we're always dealing with something. We're a very nimble company. We've been able to navigate those challenges over the years, and we'll continue to do that.
And have you seen any changes in buyers specifically here where we stand today? Not necessarily Singapore, but in the wider APAC region. Any differences since we last spoke 2 years ago?
Well, I think the biggest difference is our G700 and 800, they really offer unparalleled range capability for the region. So we're seeing very strong demand for the G700 and G800 that can do those very, very long missions.
We have seen, though, sales softening in China, particularly as trade tensions really ramped up. Do you foresee that persisting into this year?
Well, we'll see. We continue to sell airplanes into China. China has been a very good market for Gulfstream, both China and Greater China. It's not the same frenetic market we saw a few years ago, but we continue to sell and be active in the China market.
And one new change since we last spoke, COMAC now entering the business jet arena through a conversion of its C909 regional aircraft. Now, this does not have the range, and you talk about range being a key selling point, but it is reported to have a price tag at around $38 million, which is about half of a Gulfstream. What are your thoughts there?
I can't comment much on what COMAC might be doing, but what we found over the years is that some commercial airline manufacturers have attempted to convert their airplanes to, quote, business jets. They don't offer the same performance, utility, or access to airports around the world that the purpose-built Gulfstream jets do. So we're very comfortable with our current product line and how it competes in all the markets around the globe.
So it would be foreseeable that COMAC would appeal to Chinese buyers, but do you also see it heating up competition in the broader APAC region?
We haven't run into the airplane in competition yet, so we'll keep our eyes open for it in the market.
And does that, we're also seeing planes and the purchasing of planes now starting to signal political messages, using it as a bit of a bartering chip here. Does Gulfstream, have you seen any sales or any demand related to those either trade talks or any other geopolitical issues?
No, we really haven't yet, other than getting our airplanes certified in jurisdictions around the world. What we've found is, we've been doing this for almost 70 years. Business aviation is our only business. And so we've been able to navigate, again, a lot of the situations that may arrive around the globe at any given point in time. The investments that we've made in the product line has resulted in the broadest, most capable product line that business aviation has ever seen. We like to say at Gulfstream we have an aircraft for every mission. So we actually have a Gulfstream model that can fit every mission customers may be looking for, and it allows them to tailor the airplane to their operations.
And speaking of investment, are you now looking into a yet newer model to come?
Well, we're always investing in research and development. I don't have any announcements to make here this morning, but we're always looking at what's next. We've got a very strong product line in front of us with the G300 and G400, or G500, G600, and the ultra-long range G700, G800. That's going to keep us busy for some years.
Now, the downside of having such a good year like you had in 2025 is that it can be hard to top it. What's your outlook for deliveries in 2026?
Well, we're early in 2026. We anticipate delivering about 160 airplanes this year, so a little more than last year. And so far, our sales activity around the globe is quite busy, especially here in Southeast Asia. Our team here, based at our Singapore office, is very busy, and we're going to see a lot of G700s, G800s delivered into the region in the next few years.
Wonderful. Scott, always a pleasure to speak with you.
Pleasure to be with you. Thank you.
Yeah. This is Scott Neal. He's the Senior Vice President of Worldwide Sales at Gulfstream. Emily, it's back to you in Hong Kong.
Monica, thank you very much for bringing us that conversation. Monica Petrelli at the Singapore Air Show. We'll get back to you in a little bit. We'll have more from the air show throughout this morning. In the meantime, the China Connection taking a short break. We'll be right back. We're still a number of hours out to U.S. markets opening, but a quick check on U.S. futures. We did have a positive showing for the U.S. markets overnight. The S&P managing to reverse 3 sessions of losses, and we're looking at a bunch of China tech stocks, a little bit mixed here. Kuaishou shares down 7%. So if we do have those U.S. futures, we're looking at the partial government shutdown in the U.S. remaining in effect. The Bureau of Labor Statistics says it will not release the latest non-farm payrolls as expected this Friday. The JOLTS, or job openings report, has also been delayed. The January reading of the ISM Manufacturing Index came in at 52.6, just above the boom or bust level of 50, signaling an expansion in U.S. factory activity. This marks only the second expansionary reading in over 2 years after the index spent 26 consecutive months in contractionary territory. All this as investors continue to evaluate the implications of President Donald Trump's choice of Kevin Warsh for Federal Reserve Chair. CNBC's Steve Leisman has more Warsh and what we can expect from his possible policy inclinations at the central bank's helm.
On the key issue of Fed independence, Warsh has been a strong supporter. Says a less active Fed will be more independent from Congress. The risk here, few Trump appointees have acted independently, and concern he could drive rates too low to satisfy the president. On the issue of rate cuts, he says the Fed should be incorporating supply-side gains into policy now. The risk? Gains are temporary, not entirely clear, and offset by tariffs and other policies. Former New York Fed President Bill Dudley telling me over the weekend, we don't know the magnitude or the speed of the productivity gains. It's not something I would make a bet on over the next 6 months. On the issue of the balance sheet, he wants to reduce it, allowing for lower rates. The risk here, calibrating the effect of the balance sheet and rates on markets, the economy, and the reserves demanded by the financial system. Another big area. Warsh says the models have been wrong, partly so, and led to pandemic inflation, among other things. The risk? Unclear what other models he has in mind. Former St. Louis Fed President Jim Bullard telling me he would be more eclectic than Bernanke and Yellen, who both came from the model world, and he thinks that's Warsh does that's a good thing because the models are not that great, and that is a fair criticism. Hard to bet on any of these changes because we don't know the timing Warsh has in mind, the sequencing, or whether he'll muster the consensus of the committee. What is clear, as one observer told me, Warsh is the first Fed chair since Paul Volcker who is unlikely to come into office promising continuity with his predecessors.
So let's check in on U.S. futures. As I mentioned, we did have U.S. markets ending the day higher, and the S&P even snapping a 3-day sell-off. And the S&P just fractionally higher by 0.1%. The implied open flat for the Dow, and NASDAQ better for 0.25%. On the earnings front, Disney beating expectations as it experiences division, which includes Disney's theme parks, resorts, and cruises, crossed $10 billion in quarterly revenue for the first time. But shares falling more than 7% as the company warned about a slowdown in international visitors to its domestic parks due to what it called headwinds surrounding the United States as a tourist destination. The company's CFO, Hugh Johnston, sat down with our U.S. colleagues overnight to discuss the outlook for its theme parks, streaming platform, and AI. Take a listen.
Revenue was up about the same domestic and international, so we certainly feel good about that. In terms of the operating income, there's a little bit of choppiness, but that's largely because of the investments that we're making in those businesses. So keep in mind, we launched the ship in Q1, and we still grew revenue, or we still grew profits 6% in the quarter in experiences. We're going to launch another ship now in Q2. And we're opening up Disneyland Paris, the world of Frozen, and a lot of other attractions. There's a one-time cost attached to that. So the back half is going to be stronger for sure. But the fact is the business has good momentum right now.
In terms of the streaming piece of this, streaming versus linear, right now, that's the other big sort of question.
Right.
You guys have always argued you need the linear piece to drive some of the content that lives in streaming.
Yeah.
Does that still hold?
Yeah, very much. I tend to think of it as just 2 distribution channels for largely the same content. So consumers are going to shift as they choose to shift. And when they do that, we'll be there to catch them. So whichever way they want to go. I know you all are a subject of the split. We don't think that strategy makes sense.
Because Warner Brothers is doing the same thing right now.
Yeah. Yeah, they are. So no, we feel good about the integration that we have at this point. And Warner Brothers may or may not do that, depending on how the deal works out.
Piece is a drag on the business, or no?
I just think of it as one channel. And as consumers are making the shift, obviously it affects the numbers. But in totality, we feel good about it.
There is a big question mark right now about employment in this country.
Yeah.
And whether we are about to hit some kind of inflection point with unemployment.
Yeah.
Whether you think it's AI or something else, and we could talk about AI as well.
Right.
Do you fear that? I mean, you saw the number of companies, even in the last week, that were laying off employees.
Yeah.
And what you think that portends for either folks buying the streaming service, going to the theaters, going to the parks. What does that look like to you over the next 12 months?
Yeah, I mean, what we've seen is Disney tends to power through those things reasonably well, because the priority in terms of a vacation is something, obviously, if you're out of work for an extended period of time, that's a challenge. But for most people, they will prioritize a vacation, and particularly a Disney vacation is a high priority for families. And let's face it, once you tell the kids you're going to Disney, you're probably not going to reverse that one.
That's on the high end. Do you think that you're going to see more moving around on streaming, for example?
No, I actually don't. Streaming is still a relatively good bargain in my estimation compared to what people used to pay for cable.
Defense and software analytics company Palantir popping in extended trade after beating fourth quarter earnings estimates and issuing upbeat guidance. Palantir creates tools sold to businesses and government agencies such as the U.S. Department of Defense, the Internal Revenue Service, and the Department of Homeland Security. It credited the pickup in spending to increased AI adoption and rising demand for its tools within the U.S. government. A new season of Executive Decisions begins this week, and in the first episode, Steve Sedgwick speaks to Bill Ready, the CEO of Pinterest, when he took the top job at the social media company 3.5 years ago. It faced significant challenges, and that's when Ready made his toughest decision. Here's a clip.
When I came in as CEO 3.5 years ago, Pinterest was declining in users. Attrition was way up. Stock price was down 80+%. And, the narrative on Pinterest was that Pinterest was sort of aging up and aging out and had missed the next generation. And a few months after I came in, we made a decision to do private only for under 16. And people thought it was like, oh, well, you're struggling to get the next generation of users. Now you're definitely not getting the next generation of users. And, I made that decision, through two lenses. One, as a dad, I looked at what was happening and just very clearly, I could see that it's not safe for, kids to be contacted by strangers online. By the way, say that out loud and doesn't that just make sense? It's not safe for kids to be contacted by strangers online. Of course it's not safe, but somehow we've all come to accept that. The other lens was taking a bet that there would be real demand for safer spaces and that maybe that would be a path to win with young users. But it was a huge leap. Nobody done it before, completely unproven. And so that was a really tough decision. Fast forward, you asked about the best decision. I would say it's been the best decision, both in that, for us as a platform, it's now the case that, we haven't reported this most recent quarter, but as of the last quarter that we reported, 9 straight quarters of record high users, more than half the platform is Gen Z now. And if you ask them, one of the top reasons that they will give is they see Pinterest as a safe space away from the toxicity they experience elsewhere online.
You can listen to the whole episode with Bill Ready right now, wherever you get your podcasts. You can also watch it on our YouTube channel and on CNBC.com. The episode will also air this weekend right here on CNBC. And one more quick check on Asian markets, and it is a rebound that is playing out here, and most notable in the Korean market, up 4.6%. The Nikkei 225 gains pushing 3%. The laggard here is the Hong Kong market, down 0.75%. Even Jakarta managing to pull itself up. The Indonesian market up 1%, and we are looking at the RBA and the ASX 200 up 1%. In the next half an hour, we should get a rate decision, and very much a 25 basis point hike is expected. And that'll do it for this edition of the China Connection. I'm Emily Tan here. Keep it tuned. Inside India is coming up next.